some transitional news at the VCF. A year ago, we welcomed Nancy Brock as VP of Finance. And so Nancy's been an incredibly valuable member of the team for the last year. Really instrumental in terms of stabilizing and strengthening the team, and keep doing getting some key pieces of work accomplished. Due to some unforeseen personal circumstances, Nancy shared recently that she'd be stepping down as of the beginning of July. We moved really quickly. At our core, we are a financial organization. We were really fortunate to identify a VP of Finance successor and bring that candidate on board in a quick way. Allows us to have a robust transitional time and time for onboarding. But I'm really thrilled to welcome Barry Pius. You'll see on the call as a new VP of Finance. Barry is in his, I think, 5th working day on the team as VP of Finance. He comes to us with a 30+ year background of C-suite financial operations, chief operating officer roles across Vermont. And we're really excited to have Barry on board. We're sorry to see Nancy go, but we're thrilled to have Barry on board and help us steward our growth over the course of the next 5 years and the work we have laid out in our long-term business plan and our objectives and the objectives we all share for making a difference in Vermont communities in the coming years. So thought I'd pass along that news. And again, just thrilled to have Barry coming on board. So welcome, Barry.
Thank you.
Good to see you. With that, I will turn it over to Mike Miller, our colleague Mike Miller from Crucial, who's actually just down the hall from me here in the Middlebury office, where we have our investment committee meeting following this. And it's the first time, I think, since March of 2020 that we've been in person together as an investment committee and with Mike here on site. So we're excited to have everybody back together and be able to get into it a little bit. So Mike, I'll turn it over to you.
Thanks, Dan. Good morning, all. It's really nice to see you. And yeah, it is a little cold up here in Vermont today. I don't know what's going on. So I'm ill prepared for that, but hopefully not ill prepared to talk about the investment portfolio and the results, which I'm going to bring up on the screen right now. Let's move this a bit bigger. There we go. So we might be back in the office, but we're still able to use Zoom, which is good. So let's start with the results. Let me just start off with the theme of our discussion today is going to obviously be to chat about how things have gone and how we think about how things are going. But then beyond that, we also need to talk about the fact that we live in a very complicated world. And the bad news is that a lot of the complexity of the world is not reflected everywhere you look in capital markets. There's still, I think, basically a group of people out there that are in a state of denial about the future. And unfortunately, that's not usually good news for that group. At the same time, there's a lot of stuff to be really excited about. There's a lot of really interesting investments that can be made today that are basically priced for the end of the world, it feels like. And if you believe the world will survive, which we do, then there's some amazing opportunities. So we struggle with the dichotomy out there right now, and it's key. And I'll remind you of this a couple of times, but I always try to remember that this isn't supposed to be easy. And so when things feel easy, you should be worried. When things don't feel so good or easy, then you probably should be pretty excited. And that's sort of how we're feeling today. So this chart, as you've seen many times before, shows you the performance of the 3 major investment pools here: the long-term pool, the socially responsible pool, and the midterm pool. And we'll talk about some of the differences in their strategies in a minute in the mix. But the key points here are that the long-term and the socially responsible pool are both endowment/long-term oriented strategies. The difference being the socially responsible pool is a screen portfolio that is aligned with the foundation's values very directly. The long-term pool is actually also aligned with the foundation's values, but in a different way. And one of the things that we're excited about in the year ahead is the investment committee and Dan and the team. We're going to be looking at some more robust data around this topic and trying to really get our arms around it. We'll obviously want to, over time, share with you some of the things that we find in terms of how these pools align and how different they are from each other in that regard. The midterm pool is a balanced pool, so it's meant for shorter grant-making horizons. It's got more bonds, which have not felt very defensive until recently, but it's got a more balanced strategy. It should be less volatile than the other 2 pools. So what we've done here is we've compared the portfolio long-term pool to its what we call custom benchmark. A custom benchmark takes the asset allocation strategy of the pool, which I'll show you later, and uses a market index for each piece of it. So the S&P 500 for large cap US companies, and so on down the line. And what you can see here is the portfolio, with the exception of the 5-year period, which is still catching that point because we're value-oriented investors. So that value orientation has not served us well for actually most of the last 5 years, but we've managed to overcome it for most of the other periods, as you can see here. So the portfolio is up 5% year to date, which is slightly above its benchmark. We've also put CPI plus 5% there, which has become a surprisingly hard benchmark to beat of late. Although if you look at the 20-year numbers, you see the foundation actually has outperformed it and actually only did so because it has a huge premium over its own custom benchmark, which we'll talk about again a little bit later. We're also really excited about the 3-year numbers here, in part because they're the largest on the page. That's nice, but also it's for what it teaches us. Go back 3 years ago. That would have been basically April 1st, 2020 was the start of that period. The world's we already saw plunging into what we're in now, which is very complicated, obviously health, humanitarian, and economic crisis. And yet the portfolio generated outsized returns. That's exactly what I was talking about before, which is that when things get very, very difficult and complicated, if you have a cool head and you have good investments, things work out pretty well and actually surprisingly quickly, as you can see here. Now, the SR pool also has had very competitive performance over time. As you can see, it's taken a little bit more of a hit in the last 12-month period, mainly because a lot of screen portfolios tend to be a little more growth oriented. And so they're going to have more of the tech companies and the bigger consumer names that don't violate the screens. And in that regard, you get a little bit of a headwind there, although we're not unhappy with the way that's worked out. It's within our range of tolerance for this kind of thing. And then last but not least, the midterm pool, it does have, as it should, the weakest long-term returns because it's more conservative, defensive. It's not meant to be as volatile, which means if things are less volatile, they will generate lower returns over time. That's just the law of the land, essentially. I'll just give you a quick update. As the markets remain volatile into we're in the second quarter now. The long-term pool is now up actually about 6.1% year to date through last night. The socially responsible pool is up almost 7% year to date through last night. So the portfolio continues to chug along, which we're of course quite pleased to see.
Mike, I think that answers the question. There's a question in the chat from David Bardaglio at Echo, just about calendar year to date is through the end of March, right?
Yes, sir, exactly. And the numbers I just gave you were through the end of May 17th, but yes, that's so April is about, I think it's up 5.6 in the long-term pool, and the SR pool's up around 6.5, I think, at the end of April. And then they're a little higher today, as I was mentioning before. Thank you for that. And one of the problems with a chart like this is it makes all the outcomes seem as though they're the same in terms of their impact. So for example, the 11.1% return for 3 years seems like a much more important number, for example, than the 6.1% over 10 years. And I will tell you, we think it's important to see how you're doing more recently because it tells you something about how your strategy is working in the here and now. But when you look at the long-term numbers, this is where we make very, very intentional trade-off. We are willing to be wrong in the short term as long as it's right in the long term. And the reason that I think last time I was on the call with you guys, I don't know if it was a good analogy, but I'll use it one more time. We always like to think about the Wayne Gretzky analogy. Wayne Gretzky was a successful player because he skated to where the puck was going to be, not to where it was. And I think that's the whole idea, is that we want to be where the markets are going, not where they are. And that's how you get bigger long-term returns. Now, there are many differences in Wayne Gretzky and the way the portfolio gets managed. One of which is Gretzky had a pretty good idea when the puck would get there. We have never any idea when the puck's going to arrive. And so it's tricky from that perspective. So that's why when you look at something like the 5-year return here, that it's subpar. We're below the benchmark. But here's why we do it. Because look at the 20-year return. And let me just explain what this chart is for a second. This chart takes the exact same numbers you saw here. These are the same returns. The difference, though, these are compounded. And compound returns are what really matters at the end of the day. We're trying to sustain the foundations and the foundation's impact over decades. And so we care most about long-term returns. We don't not care about short-term, but everything we do is oriented to what's the best long-term outcome. And by the way, that's why the portfolio returns the last 3 years have been so good. We didn't sit around and say, oh my gosh, the world is so much different. It's so scary right now, which all is true. and say we need to do something different. We need to think about what's going to happen next. We did think about it, but we had to really do is think about what are we going to be sitting back here 5, 10, 15, 20 years from now thinking, and let's make decisions that we're going to be proud of then. And that's why we get to the kinds of returns you see over these periods of time. So the 3 years, you can see here that 11% return I mentioned before compounds to a 37% return versus 33.5% for the benchmark. The 5 years, again, we don't like being behind benchmarks. That's never makes us happy. But if we have to be behind the benchmark once in a while to get the returns we want long term, we tolerate it, frankly. At the end of the day, I'll show you another example in a minute about why we do that. 10 years, you can see 81% return versus 76. So those 6% numbers, they look a little better here, but I think the big number is the 20-year number, obviously, where that relatively small looking difference, remember, 7.7 versus 6.8, actually translates into a 341% return versus a 273% return. And this is why we do it the way we do it, because those gaps are important. They make a big difference. And if you go back one more second, CPI plus 5, returns 7.5% per year. So this was the difference between preserving and not preserving purchasing power. And we haven't preserved purchasing power, as you can see, over 5 years or 10 years, but 20 years we have, 3 years we have, and we will catch up over all these periods. I'm not worried. Go to the next slide. Oops, I think I have some thinking. So this is a look at the socially responsible pools batting average, we call it. So let me explain what this chart is. So all these other charts I showed you before are this one moment in time. In March of 2023, how did you do for 5 years, 3 years, 10 years? And that's fine and interesting. But we know for a fact that when we look in June of 2023, it's going to be different. And when we look back in December of 2022, it was different. And all these other periods are different. So the way that you really want to assess whether a portfolio is working and doing what it's supposed to do is you want to look at multiple endpoints. And so how we do that is we go all the way back to the beginning of this pool. There's one more. Let me see this going. Yeah, there we go. I don't know why they did that. Go back to 2010 when this pool was restructured, all the way through 2023, and we look at every single 3, 5, 7, and 10-year period. Roll them up every single month. And then what we do is we look at the batting average, which is, okay, what percentage of the time, 3, 5, 7, 10 years, did the portfolio outperform net investment management fees, that custom benchmark I mentioned to you earlier? The expectation is we believe we want to be in the 70 to 80% range minimum. That's important. So you can see 3 years just slightly behind it for the SR pool, but for the other periods, 5, 7, and 10 years, 85, 90, 88, 93, 88%. So very high batting averages, which means makes it easier for you, makes it easier for the investment committee, gives Mike Miller and Crucial a little more job security when we're not constantly underperforming and making you wait forever for some good performance. So those batting averages are very high, which we're very proud of. Then you look at the median outcome, which again, this is cumulative, so not per year, which is you also have to ask yourself the question, well, I want to outperform, but I know I'm taking the risk that I might not outperform. In fact, most people don't outperform. So if that's the case, I need to get paid something to take that risk. And that's the cumulative outperformance that we want. And so here, those numbers get bigger because they're longer periods of time, but we will take 5, 6, 7% or more, and you'll see the long-term pools have more outperformance. That's worth the risk. Because think about 7% over a 10-year period, that has a really significant impact on grant making and the way your portfolio, the way your funds can behave philanthropically. Then you look at the best and worst outcomes, and with the exception of 3 years, which we're not thrilled about, they skew positive. So the best case outcome over this period was there was a 9.9% 7-year return premium. The worst case scenario, so in that 93% at the top, we did have some underperforming 7-year periods, but that was a 2.6% downdraft. So again, we want positive skew, we want a high batting average, and we want a median outcome that's worth it. So this is the SR pool, which actually is interesting in many ways. It's I think this is going to change in the year or two ahead, but it's got a lot of passive management. So what that does is it essentially keeps the fees down, which is nice, but it also keeps the portfolio a little closer to its benchmark. The long-term pool is a little bit more aggressive on the active management side of things. And this is a different time period, but same basic math, which is, so it's different because the pool, we started here actually in early 2002. That's where the start period comes from. And you can see here, the batting average is actually are very similar to the SR pool, with the exception of being the 10-year, which is 100%, which really bugs me because I know that can't possibly last forever and I just don't want to be around when it changes. But with that said, it's a very strong batting average over 10 years. So the investment committee's never sat down, nor have any of you, of any single 10-year period over the last 21 years and seen underperformance for 10 years. They've seen underperformance for 3 years and 5 years I showed you earlier, but not one time. Now you see those median outcomes are much, much bigger. That's again because of more active management, excuse me. Also, having a longer time period gives you some more interesting volatile markets to play with. And the more volatile the markets are, the more uncomfortable we get, the better it is for us. Best outcomes, really, with the exception of 3 years, which isn't that great, but they really significantly outweigh the worst outcomes. And so this is, again, we would argue, a sign of what you want. We do sometimes run portfolios that are not ones we advise, that we get sent them to take a look. And it's not uncommon to see 50% batting averages, by the way. So that's the norm, is 50-50, not 90 or 80 or 100. And the median outcomes tend to be small, and the best and worst outcomes tend to be about the same for each other. And that's the coin toss type of strategies, which one time you look, they're good, one time you look, they're not. That's not what we have here. Here we have really strong, consistent delivery of return, and that's something we're very proud of. The other thing we do, if you look through our portfolios and our strategies, is we really put a lot of emphasis on diversification. It's actually at times like the one we've been in up until recently, where we really just wanted to own the biggest US large cap companies. Nothing else really did nearly as well. It's really hard to be someone who diversifies, because you sit yourself and say, why am I doing this? Why are we doing this? It's not worth it. We might as well just buy Apple all day. And the reason we do it is because we actually think that this money is actually not here for any of the reasons that I've been showing you. We're not here to show you a high batting average. We're not here to have returns that are above benchmarks. We are, but what we're really here is to maximize the value of your capital. So the capital you and other zips are generously put forth to be invested in the state of Vermont needs to grow. And that's the only thing we really should be caring about. So in order to illustrate how this works and why we diversify the way we do, we simulate, we use real returns, but a pretend fund. So we pretended that a $1 million fund showed up here in 2002. That was the beginning of the long-term pools track record you saw earlier. And then what we did is we invested it in one of 3 portfolios. We invested it in the long-term pool, that's the blue bars, in a simple 60% global stocks, 40% bond mix, that's the orange bars, and in just global stocks, 100% stocks in the gray bars. And the point of this is to prove something important, which we do prove, which is that the diversification actually pays off in the ways that matter most. So first set of columns, last thing, left Vermont. Nothing was added to this fund since 2002, so the 1 million came in. And then what happened is we took 5% per year out of the 12-quarter rolling average, and then we spent essentially as you'd expect. So the fund balance change was at the end of March. How much more was the fund worth than when it started after all the grants and expenses came out? You can see it's actually about the same as putting it all in stocks, which is interesting. You think about it, because I'd say, well, then I guess you didn't need to go through all this trouble. You could have paid a lot less fees, just owned the 100% equity index. You would have been just as well off, that one measure. True, except till you get to the next set of bars, which shows you what was taken out over time. And again, remember, the first set of bars are after what was taken out. So you have to consider them both together. They're not in isolation from one another. And there you see the spending from the VCF long-term pool version of this portfolio of this fund was significantly higher than it was if it was 60-40 or global stocks. And then total philanthropic impact is sort of a made up thing that we did, which is we said, well, let's just take the 2 bars and add them up so you can see, because this is the actual economic output of the portfolio strategy that you see at work. So the pool, because it's diversified, because it has much more balance, because it's a lot less risky than one single stock index, has really made a big difference over this 20 some odd year period. And the problem is, for the index strategy, it gets even worse when you look at this. So all we did here, remember this middle bar, this is just the cumulative spending over the entire 21-year period. This is what that spending actually looked like year to year to year to year to year. And what you can see here is, so let me remind you what these things are. So the blue line, again, is the long-term pool, every year spending. The orange line is the 60-40, and the gray line is the All Country World Index, again, which is the one that looked almost as good in that first set of chart bars as the other 2. But look at the spending patterns. The blue line is not only higher all the time, it's a much less volatile line. Look how volatile that gray line is. And what we did is we drew those little green and red lines to show you something, which is there was really one significant drawdown that lasted, which is the 2008 financial crisis, of course, for the VCF pool. And you can see that from basically 2008, 2009 to about 2012 or so, it took that much time to kind of get back to where we started in terms of peak spending. And then since then, it's only gone up pretty much steadily since then. But then look at the red line. That's that again. Hey, why don't I just put it all in stocks answer? And you see there, It took 11 years to catch up to where we were in 2008. And, we don't like even the 3 or 4 year pause, but 11-year pause is absurdly horrible. And it's a complete, violation of what we're trying to do here, what you're trying to do with your philanthropic capital. So diversifying is really important. And that's why we tolerate all the different things that you see. We own things that aren't popular. We don't have it all on the S&P 500. Because this movie has been written over and over again. We always know how it's going to end. It ends the same way every time. I'm going to give you that in a second. But before we do that, let's talk about the strategy that got us here. And one of the things that is really important is that we're not doing anything fancy here. There's no investment geniuses, forgive the investment, the investment committee, but there are no investment geniuses anywhere in the world as far as I'm concerned. All there are people who work hard, stick to their knitting in terms of what they know, what they don't know, and really focus on the outcomes and the reason they're here. And so we just do those things, and we do them very, very simplistically and very consistently. So 3 lines. First part of the strategy, think long term. The investment committee is going to meet today. We'll definitely talk about the world. But at the end of the day, no one's going to move any money or make any investment decisions because we think there'll be a recession in 2023, or we think the Fed is going to do this, or we think the price of gold is going here. We don't know those things. And since we don't know what's going to happen any better than anyone else does, there's nothing actionable there. And that's the problem I think people have when they try to make forecasts and then change their portfolios, is their forecasts are inherently based on nothing. And that's a problem. So the second point, as you just got from the first point, is there's no market timing. Again, I think we're always asked the question, particularly around budget season for any of our clients, what do you think the market will do this year? And I hate that question because we really don't know. I said, you might as well answer the question yourself because you know as much as I know about that. But we don't try to make short-term forecasts. And then back to this last point, we do diversify because at the end of the day, this is all about risk. And the other problem I will tell you is that you get one chance to get this right. If you have a terrible year, 3 or 5 years, you can destroy the impact of this capital. So we cannot have those kinds of risks in the portfolio. And diversification is the easy path away from that. And the problem is that to be truly diversified, you really have to do things that are different than everybody else. If you're doing something that everyone else is doing, you're probably not that diversified. As I'll show you later, if you're in the index today, you're shockingly lacking in diversification. And I think that's something that should be very concerning. So here is the comparison of the 3 pools that we've been showing you. So the long-term pool is 60.5% in stocks, 17.5% in bonds, and 17% in alternatives, with the 5% in Vermont investments, which are one of the coolest things that are done here over 20 years so plus. Socially responsible pool is a similar pool, except it doesn't have hedge funds, as you can see. But it does have a very heavy stock allocation. It's got a little bit more in bonds to basically compensate for the lower level of no hedge funds and the lower level of private assets. Social responsible is an area, by the way, where there's a lot of interesting private asset investing that we're doing these days. So we're really excited about that. And then the midterm pool is more balanced than that. As you can see, much higher bond allocation. We diversify it quite a bit, though, including almost 10% in short-term bonds because of the way the world is these days with interest rate levels, as they've gotten higher, but they're still kind of complicated, as you know. So nevertheless, this is the mix. The committee reviews this annually, or as often as they'd like, but generally annually. And we're actually having a part 2 discussion of the last meeting, which was about this mix today. So it'll be interesting to see where all that turns out. One last thing on this page, you'll see the equities are diversified around the world, and you can see, quite significantly, basically 11% is in US large companies and 11% is in non-US companies. And that's been a really, really helpful thing to the portfolio of late. Special opportunities, just so you know what that is, those are basically equity strategies as well. They're just more concentrated, a little more complicated, and they're where we get a lot of the value and the outperformance that I showed you earlier comes from that segment of the portfolio. It's one of the things that's really great about having a multi-$100 million foundations. They can access investments that otherwise are difficult to access. So if you were so I'm CIO at Crucial, and if you were on our 22-person investment team today, we would teach you a lot of things about how to do investing right. And here are the 4 things that we focus on Crucial and try to find managers for our clients. The first is returns are always accompanied by risk. We do not look for risk-free investments. We do not look for investments that have extremely high returns and no risk. And not because those things wouldn't be wonderful, but they don't actually exist in the real world. And so once you get over the fantasy of what investing you'd like it to be and accept the reality for what it is, you have a much healthier relationship with your investments. And the issue isn't that we're trying to avoid risk, we're trying to understand risk. And when you do that, you can do two things. The first thing you can do is you can decide whether the risk is worth taking. Am I going to get paid to take that risk? Is a question we ask ourselves all the time. The second thing you can and should do is think about what happens if that, when, not if, that risk comes to bear. Can you live with that outcome? There are some risks which are not tolerable under any conditions, in which case don't take them. And I think that's a really important part of how we think about things. The second point, we must understand the strategy. So we've at Crucial, we have a lot of people. I've been doing this for, 36 years. Seen a lot, talked to a lot of people, know a decent amount of these things. And if we run into something that we don't understand how it works, we move on. We must know what people are doing. So that keeps us away from a lot of computer generated quantitative type strategies, not because they don't work, but because we don't understand how they work, in which case we can't invest. But as you see here, know the key people and avoid needless complexity. So when things go wrong in the portfolio, they always do, we can at least very, very clearly explain to the investment committee and to Dan and the team what exactly is happening here. And that's really important. And then we can decide what to do about it, of course. So these are very important issues. Operational issues is a place where we do not take risk. This is the old, I'm glad to say now, old Bernie Madoff risk. We have a 2 to 3, depends on the day of the week, operation due diligence team. The third person is a contract person. That's why I said 2 to 3. That all they do all day at Crucial is make sure that all of our clients' assets are operationally sound investment vehicles. So independent custodian, credible auditor, outside administrator, these things are table stakes. You must have them. If they're not there, you cannot invest. That's a risk we never take. And then last but not least, this is an ongoing forward-looking process. That's the other mistake people make as investors, is they look at track records and they assume if it's good, the person's good, or the firm is good. If it's bad, they're bad, and it ignores the cyclicality of things. So I think if you really want to find the secret sauce in the foundation's success, there really were 2 things, 3. One is thinking long-term. 2 is finding some really extraordinary investment managers to invest the foundation's capital. And then 3, and maybe most importantly, this is where the investment committee and Dan have been so critical, be patient. A lot of times you have to be really patient, and patient is hard, especially when we, as you would hope, feel extremely responsible for these outcomes and the impact they have on your grant making, on the foundation, and on the state. With all that said, we still have to be patient, and we'll have to below this. This is a partial list of what a Crucial analyst does in a research report. We'll move on. Sorry. So let's switch gears and talk a little bit about what's happening in the world. This is a very, very complicated time. And we've talked about this before. You thought COVID was complicated, and that was complicated in a different way. This is probably more lasting. And I think that might be tougher for some people to deal with in some ways. At least I hope it's more lasting. So first thing, we actually now have higher inflation. And you'll see here, we wrote next to that, higher cost and competition for capital. So to think about that, there's a couple ways to think about it. But the biggest way is, when you think about competition for capital, what that means is that we, everybody have more choices than we've had before. So in the past, most of the last 13 years, think about what you did with your personal assets. You could have put your money in a money market fund and made nothing, or you could have taken risks of different shapes and sizes. And so the whole system was geared to force you out the risk curve, essentially, and make you take on risk. Now today, you can get yourself 5% almost on a money market fund or a T-bill. And so you have choices, and that's what competition for capital means, which is, should I put my money in the stock market or should I put my money in a treasury bill? And it's a real choice today. It's actually a really interesting choice if you think about it. So that's good for you, not necessarily good for those who consume your capital and want your capital. And it makes it more expensive for companies to raise capital, it makes it more expensive for governments to finance their deficits. There's a whole bunch of different things that this means. And our view is that there's been a sea change, because we do now have a more normal economic climate in some ways, and the Federal Reserve and other central banks around the world are basically being forced to abandon the strategies that push you into that no option place you were in before. So again, pick your poison. We like this a lot better because I think it's more reasonable. It also helps us get higher returns, so we're happy with it. Central banks and high-risk investors are no longer aligned. The bubble that started to burst in 2021, that didn't happen by accident. It happened because if there's no more free money out there, which is what there's been for 13 years, suddenly companies are going to fail. Companies that needed tons of cash to grow aren't going to have it. We'll talk about the venture capital community in a second. But my point is that everything has changed, and it's not just changed for a few weeks or months or a year. It's changed in a very secular, potentially 10 to 15 year way, just like we changed after 2008. If you want to know who a high risk investor is, I'm not going to name names, but I'll just say this. If you see anybody, CEOs, mutual fund managers, anybody complaining incessantly about higher interest rates, that's the people that are basically being hurt. It's basically simplistic, right? So anybody whining is essentially on the wrong end of this structure, and they're in trouble and they know it. Last but not least, we live in a complex system. It wasn't that long ago. In fact, I was trying to take a vacation for once that Silicon Valley Bank collapsed. And when that happened, it set off a chain reaction of other things that are still happening and will continue to happen. I'll talk about that in a minute in the system. And all the point is that everything is happening is connected. We live in a very interconnected world. We live in a very interconnected and complicated financial system. And even I will tell you, spending literally every waking moment of almost every day of my life trying to understand it, there's still a lot we don't understand. It's very complicated. So let's talk about the very clear sign of the way the world has changed. So this is, I think, a really interesting graph. It's showing you the level of bank failures. So the blue line are the number of bank failures from 2001 to 2023. The gray bars are the assets of the failed banks, essentially, that haven't been taken over by the FDIC. And what you can see here is, first of all, if you look at the blue line, the 2008 to 2011 or so period, 10 period, is where we had tons of bank failures. And that was the great financial crisis. It led to a lot of the policies, by the way, that we are just now starting to undo today. But if you look at to the right, there's no problem. We haven't had a lot of bank failures in the United States this year. That's true. But now look at the gray bars. That's the size of the banks that have failed. So I was going to say Credit Suisse has failed, but they're not a U.S. bank. Silicon Valley Bank, Signature, and First Republic. And their assets, in this chart is accurate, they dwarf the assets that were essentially in the failed banks in 2008. And so the impact of this should not be understated. So this is really important, and think about how fast it happened. So we have higher interest rates, we have this higher cost of capital, and at the same time that's happening, you're hollowing out the regional and mid-sized banking sector in the United States, because this is the tip of the iceberg, right, of the panic that's been going on in banks. And when you do that, what's the implication of that? Well, simple. Less loans, less capital, again, flowing to support businesses in the economy. That's not a good sign for anybody. It's very risky. And yet, while this is all happening, the S&P 500 is chugging along like there's literally no problem whatsoever. So these are, and I'm going to torture you with all the details, these are a variety of different ways to think about how expensive or cheap the stock market is. And the stock market, I shouldn't say that, how expensive or cheap the S&P 500 is. The stock market today, by the way, is not expensive. The S&P 500 is expensive. It's a very big difference. So again, if people have questions about the specifics, I'm happy to describe these. But basically, the key point you should walk away from this chart from is everything's in the red, with exception of maybe one little piece in the orange at the bottom. So what that's telling you is not that the stock market's about to crash, doesn't mean that at all. What it means, though, is that the stock market is pricing in a very rosy future. And if the future is just good and not rosy, that's going to generate subpar stock market returns. And that's why we love to own stuff that's in the green, because we don't need to actually have great things to happen. We just need to have things that are happening that are better than what the stock prices are saying. So when you have the stock price on the red, a lot of really good things have to happen. And we find it fascinating that the leading S&P 500 companies, which are the ones driving this outcome, there's a really simple way to explain the risks they face. Forget about cost of capital. Forget about all those things. Think about one thing. We live in a multipolar world today. We live in a world where China and the United States will continue to become more and more at odds with one another. This is not going back to anything happy or friendly to our countries, obviously. And yet most of the S&P 500's biggest companies are highly dependent on healthy relations between the US and China. And maybe that'll be true. But the fact is that I don't think it's such a safe assumption that it will be true. And these prices suggest it is. And that's why this market is so risky today. It makes us really wonder. And to make it worse, I made this point earlier, the stock market is not the S&P. This is a graph that shows you, we're using the growth index as a great example of this, but this is a graph that essentially shows you, take the two largest names in the index and add them up. So let me step back for a minute. Indexes are created with something called capitalization weighting, which means that the size of the company, stock price times number of shares outstanding, determines the index weight. And so the bigger a company gets, the bigger its weight in the index. So this graph goes back to 1995 and says, okay, let's just add the two leading names in the index and see what their weight was essentially. And what you can see here is Apple and Microsoft, I think it's actually higher today, I think they're almost 27% of the index, right? Of the Russell 1000 growth index. They are almost 15% last time I looked of the S&P 500. Two companies. And the reason I mentioned this point earlier, concentration is a risky thing to do, particularly concentration basically accompanied by comfort and momentum. Where these things are popular, basically. People love Applesoft and Microsoft stocks, and Apple and Microsoft, excuse me. So really interesting. And you can see this is an unusually high level of concentration. And I went back to the late 90s, GE is the one listed here. There are other companies like Cisco and others that were also top names, and yet they have not been good stocks. And I hate to tell you guys, but unfortunately, companies like Apple and Microsoft, maybe they'll defy all history, but we don't invest on that basis. We just think that it's really important to remember this first point in the belief. There is no law that business quality and stock prices are correlated. Companies can just be very good businesses, but their stocks are too expensive. They're very bad investments. And so this is a really interesting problem in the indexes today. And I made this other point I want to emphasize one more time. This is not a universal problem. This is not, oh my God, the whole world is concentrated. The whole world is overvalued. It's not that at all. Take a look at this. This is the same exact chart, except for the value index. So value stocks are things like banks, energy companies, cyclical businesses, industrials, everything that's not as exciting as Apple and Microsoft admittedly. And here you can see this index is actually less concentrated than it's been over time because of the beating down of these names. And that's what gets us excited, is there are all these assets out there that are being priced for the end of the world. And the world's actually, we think it's going to survive, even though it's going to be tricky. So our strategy is very simple here. We rely on decisions with a high probability of long-term success, which means we avoid things that we know have a high probability of failure. So I mentioned the index is too concentrated today. It's too top heavy. It's too expensive. It doesn't account for the risks. We have less of that as a result of that. And we own things that work the other way. We have scale here, stability. The strategy has been executed, as you saw earlier, for over 20 years now successfully. And that really helps it with its history, its present, and its future. And we have a long time horizon, which is extremely important. And then this last point, which we've highlighted at the bottom, we are taking on volatility because we know that's how you get paid. And we're also taking on, frankly, the risk of being embarrassed a bit in the short term because we really think these long-term outcomes matter most. So thank you so much for your attention and time. I see a question in the chat. Should I just jump to that? Does that make sense? Oh, that was Dan telling everyone to raise your hand. Sorry, that's not a question. But thank you very much. And I'm going to stop sharing for a minute so I can see people on the screen and see if there are questions that anyone would like to ask.
Yeah, any questions for Mike or I? There are no questions. I do want to draw folks' attention, a piece of our portfolio, and one of the benefits of working with the Vermont Community Foundation for your philanthropy or your management, if you're a nonprofit reserve or endowment fund, is the allocation to Vermont investments. And on the call today is Lawrence Miller. I'm not going to ask him to comment or anything because I didn't tell him I was going to call him out. But Lawrence joined us about 7 months ago as a senior advisor in Vermont Investments to help us organize the portfolio and retool our Vermont investment policy statement and our strategy for that work. Many of you all know Lawrence as a former Secretary of Commerce, entrepreneur, and a business consultant and strategist with a long history in Vermont, advising a lot of small businesses, a lot of value-added businesses across the state. So it's been great to have Lawrence on board, offering sort of senior oversight and partnership in stewarding the Vermont investment pool as well. Thanks, Lawrence. So any question for Mike? Mike, do you want to talk a little bit, one question, that came up during the course of events around Silicon Valley Bank was the degree of exposure we might have had to the Silicon Valley Bank. Do you want to speak to that quickly?
Yeah, that's a great question. So there were two things we were focused. So the short answer was virtually none. And the virtually part is virtual because we do own index funds, and Silicon Valley Bank, Signature, First Republic, we're all in the index. And by my little tirade on the index before, this is not an example of that. Indexes own everything, and they're very small exposures to those banks. So we had that exposure there. We were worried about our private equity and venture capital investments because some of our, one of the things I don't think we didn't put this, it's in the committee memo, but you can't understate the significance of Silicon Valley Bank in the Silicon Valley ecosystem, which is why I'm still surprised how quickly venture capitalists abandoned them, because they need Silicon Valley Bank to survive. Didn't seem to think about that for some reason. But with all that said, we had, like everybody had, investment firms that were using Silicon Valley Bank as their bank. We were sending capital calls to them, and they were, they were important. So fortunately, though, none of that. We did have some anxious moments in March around just making sure all the managers, we knew what was their exposure if the FDIC didn't step in and basically guarantee cash deposits above the limit, all those kinds of things. And we didn't, it was never material in our perspective, but it would have been, again, not the kind of way we ever want to have a negative return from a bank failure, essentially that way. Long story short, everything did get bank stopped. And so there was no significant impact at all. In fact, the portfolio was up that month in March. So it was okay. But we did have to worry. We spent a lot of time on that. I'm glad it all proved needless, because that's a good outcome for everybody. But yes, so that's how that worked out.
Thanks, Mike. Since we've got more time on the call, so if there are questions, happy to keep talking with Mike. If there are questions more broadly about the VCF right now, we've got 15 more minutes or so. I'm happy to address any other questions that people may have. Anybody? All right. Well, if there's no additional questions, I'll say, that we are going to go upstairs and meet with the investment committee. So for those who are unfamiliar with the members of our investment committee, we've non-director advisors who participate: Rod Buck, Julie Wan, Dave Wilkins. I'll serve on the investment committee. I may be blanking on somebody. I'm not looking off the list. And then a number of directors: Mark Foley, Tim Briglin, Allison Lockman's our board treasurer, and I serve ex officio as CEO on the investment committee. So we'll be doing a much deeper dive onto the performance of assets in the pool. The pool is managed by Crucial over the next few hours. Obviously, the last few months have been, a reassuring turn, somewhat reassuring turn of events, but we've got some ongoing diligence to do. So I just, for the benefit of folks who engage and are on the call, I also want to finish where I started, which is expressing gratitude to Nancy for her service and stewardship and partnership in the last year, and really enthusiasm and gratitude and excitement about having Barry Pius on board as we look ahead. Reach out through your philanthropic advisor or to me directly if you have questions that you don't want to that surface after you have time to process some of this. I'm happy to dive in and have a deeper conversation. But most importantly, we believe very deeply that partnership is the infrastructure of the next 5-10 years. That's how good things are going to get done in Vermont. So thank you for your partnership with the Vermont Community Foundation and the work we get to do together because of it. All right. Nice to see everybody. I hope you all enjoy the sunshine. Happy spring. Watch out for the frost.
Thanks, everyone.